Hello and welcome to Investing Confidential. A number of months ago, I talked about the inflection point of the election, November 7th, and talked about how I thought it was going to be a big inflection point and the turning point of what I call the Wall Street, Main Street trade. So after 1 month of the current administration, things are falling into place. So that was an inflection point. The beginning of the fall of financial assets. And so I'm just going to go through here. That's the trade going forward. How do you put that on trade is up to you. I can give you some suggestions, but you want to be out of Wall Street type of assets and you want to be in Main Street type of assets. And you could see the beginnings of this very easy right now because you're looking at the new administration taking a protectionist view, right? America first, that type of thing, getting out of the wars. And if you look at the S&P 500, forgetting about the Mag 7 for a second, I'll talk about them later. The S&P 500 is overweighted with global companies that have benefited by globalism, right? So the Honeywells and all these others, even the Mag 7, I think 60% of their revenue come from outside of the US. So the S&P 500, which is a worthless indicator, right? It's not a leading indicator. It's a worthless indicator. It's being manipulated by politicians, et cetera, because it's involved now in consumer price index, GDP, all of this. It's a worthless indicator, but it is what it is. And we're seeing the beginnings. You're seeing it in the markets today, especially this fourth quarter, and the looking forward, that all these global companies are going to have problems because if they fall into line with the new administration, they're going to be bringing back manufacturing here, operations here, taking it from low-cost areas. What does that mean? That means shrinking margins, right? Shrinking margins. That's the bottom line. And all of this is inflationary. Right? All this is inflationary. Now, there's positive aspects of this kind of inflation versus what we saw under the last administration, which was really, really bad inflation, driven by monetary inflation. This will be less monetary inflation and more kind of real inflation, whatever that means. But let's go into the signs of the Wall Street versus Main Street. So Wall Street driven by earnings, right? The markets, everything in Wall Street driven by earnings estimates, all of this thing. But we're seeing a really dangerous thing today. If you look here today, and this has been going on since this phenomenon since the pandemic, that companies are beating earnings, but the stocks are falling. Now, going back in history, this doesn't happen very often. This is a short chart, 2011, but since the first quarter of 2020, so you had stocks that reported good earnings that went down. Then we had a long period where 2-3 years didn't happen. Now we're seeing it every few quarters going down, going down, going down. This is a bad sign, folks. It's a sign that momentum is deteriorating, and you don't. I mean, if you're in stocks that beat earnings and they go down, that means that's not good. Bottom line, it's not good. And you're just seeing it here on earnings expectations. I'm going to show you a bunch of charts on earnings. So this is earnings expectations for 5 years, forward 5 years, backward. And going forward is the light blue. This is the Mag 7 now, again, which controls the entire movement of the S&P and the Dow and everything else. And the whole world, by the way. Earnings expectations are really down going forward for the next 5 years, which kind of makes sense given what's going on, but not good for the market. Not good for the market. And more signs of earnings is, again, the Mag 7 looks like they've topped out, but look at the rest of the S&P. I mean, horrible. And again, this in a market that has all-time high valuations. I mean, look at this. This is a nightmare for any fundamental analyst or anyone who looks at things that drive the market. Earnings lower, right? And so, and the last I'll show you, this is the sentiment, upgrades versus downgrades or total estimates. This isn't good, folks. Earnings sentiment is falling off a cliff for the US. The rest of the world is actually going up. So this, again, another sign that the current environment going forward is not going to be good for these large globalist Wall Street companies. They could be good for, obviously, domestic orientated, but not good for global companies. And we're seeing that already. And you could see it in some of the indicators. I mean, this goes back to 1990. There's the fewest amount of stocks outperforming the S&P itself. So companies within the S&P outperforming the S&P. I mean, again, going back to 1990. Again, very bad sign for the market. Very, very bad sign. And then you want to talk about valuations. Again, this is a kind of a blend of different valuation metrics going back to 1900. We're at the same level right before the crash in the late 20s. Doesn't last, folks. The history tells you, okay, it may last a couple of years, a few more months, but it doesn't last. History tells you it's not going to last. It's impossible. And then the earnings indicator that the professionals use, the Cape-Shiller, it's adjusted earnings per share, earnings. You're at a level that we haven't seen, a little bit lower, but we haven't seen since the bubble, the technology bubble in 2000, which was probably the all-time high in terms of valuation. So we're seeing signs of earning deterioration. We're seeing signs of, we know that the market's incredibly overvalued. So what could be the trigger? Right? What could be the trigger? And the trigger is very simple. We saw it just recently, inflation, right? The market's rise from the last year has been driven by the expectation of the Fed cutting rates. And the Fed did it to try to turn the election, I think, in my mind. They did it political reasons. And here we go. We are following it's eerie, very similar path from the 70s. Big spike in inflation. We're down here where the arrow is. And if we go into this, we're going to have another big spike in inflation. And if you see what the administrator is doing with cutting with the Doge and everything else, it's inflationary. It's inflationary. And again, I'm going to show you some more signs of this. Again, inflationary in certain stances could be good for the American worker. And this is not monetary inflation, okay? Though everything seems to be monetary inflation. This is less monetary inflation and more sort of manipulated inflation. So that could be the trigger. And then you say to yourself, okay, well, every time the market goes down, it usually goes back up again. Okay, I'm not going to argue that. But here we see that it's a different time. We are at the lows going back, to me, it's 15 years. We're going back 25 years in cash levels. No, everyone's fully invested, folks. This is what this is saying. Everybody is fully invested. So where's the cash going to come from to buy things on their way down, buy assets on their way down? Usually it comes from hedge funds who are trading and they're short. And as you can see here, there's nobody short. This is all-time low. I was a portfolio for a hedge fund. I was long a stock, I was short a stock. And when stocks go down, the hedge funds buy, right, to cover their shorts. They kind of put a floor to the market. That's gone. There's nobody short now. They've been burned. Market's going momentum. all-time low shorts. That's huge red flag. A huge red flag. So you see this here and you say to yourself, man, like this is bad, right? This is Wall Street. And if you look at Wall Street itself, these are these large banks. It's a small cabal now. There aren't that many left. You've got, just recently, as you can see, HSBC pulled out. Not a big player, but a huge bank. Barclays, all these banks in Europe, outside of UBS, are gone in terms of investment banking presence. So you got a small cabal. You got a handful of New York-based banks: J.P. Morgan, Merrill, Bank of America, Goldman Sachs, Morgan Stanley, etc., including UBS. And they don't care about the average stock. As you can see here, all they care about is the Mag 7. This is a scattered chart of what analysts are looking at. They don't care. They don't care about you. They don't care about the companies, the small cap companies. They don't care. They only care about a small amount of companies. This is Wall Street. And their biggest moneymaker, which for many years was China, that was a big moneymaker for them. They all made a ton of money in China. Well, that's gone. They're leaving. And that's actually a good sign, probably a sign that China's bottom when all these moronic investment banks who are all follow the leader, they're all leaving. They're all leaving. So Wall Street's having big problems. Despite record earnings, I mean, it's funny how they all reported record earnings, but man, things are crumbling underneath them. And here's an indicator that nobody's going to show you. You're not going to see this anywhere else, not even on CNBC, nothing. Is these are the real villains, right? These private equity firms, Blackstone, all these other clowns, and this whole private credit bubble, which I've talked about, which I'll talk about again. I'm going to have to explain it. This is LBO leverage and what they call the debt cushion. So the debt cushion. So when you have a private equity or an LBO, what you do is you have a lot of borrowings and you get new equity, right? So there's a difference between the equity and the senior debt, which is what the big firms make their money on, right? They keep all the senior debt. In between is junior debt, unsecured. They call junior subordinated, whatever. That's what you buy. That's what they pump out to the ETFs and your brokers at wherever your broker is, Goldman Sachs, Morgan Stanley. Hey, buy this bond, high yield. That's what you own. That's the cushion, what they call. So if something goes bad, the first thing, the equity goes to zero. Then you have this cushion, this other debt that's worthless. And then you have the senior debt, which always gets worth something. But there's no cushion anymore. It's gone. Significantly gone. And so these firms are very vulnerable now. Wall Street, very, very vulnerable to a downturn in the economy and to rising interest rates, which potentially we may see. And so these guys are going to get hit very, very hard. And nobody's going to cry for it. But again, the end of Wall Street, or not the end, but the crumbling of Wall Street versus Main Street. So being negative, obviously, there's a reason to be negative, but there's also things to look forward, positive for. Well, here's something to look positive again if you're a worker. Again, Main Street is the real economy. It's not stocks and bonds. So you have now, you've had you look back since World War, this is again, but World War II, and I'm going to get a little crazy on this, but wages as a percent of GDP has collapsed. GDP has gone through the roof, but wages as a percent of GDP collapsed. What does that mean? That means that we have disparity. That's why they call this is the main reason for the wealth gap, folks. You hear about the wealth gap, the disparity between the CEOs who are Wall Street's not pincushions, but puppets, and you have the workers, the wages, very, very low. It's a disgrace. What this means is the average worker can barely afford to live, especially low-paid workers, right? Like hospitals and hospitality. We don't pay in this country a living wage. Now, I am not a Bernie Sanders fan, but I do agree on one thing, especially since I've traveled the world. Things, you have companies out, and this again, another reason why earnings are going down. Companies are going to be forced. They're going to have to raise their wages. They have no choice. They have no choice. With all the tariffs and stuff, they're going to have to build things here. And they're going to have to pay living wage. When I say living wage, the biggest example is you go outside the US to a restaurant, whether it's Brazil, whether it's Hong Kong, whether it's France or Germany. You get your bill, there's no tip. No tipping. I love that. I'm sorry but I hate tipping. It's a pain. It's become a pain in the ass. As you know, everyone in the US, they want you to tip for everything. Get a cup of coffee, tip. Go to a restaurant, tip. Buy bread in a bakery, tip. Buy a bagel, tip. I'm not tipping. I'm done tipping. Because anywhere I go outside this country, there's no tipping because people are being paid a living wage. If you work in a restaurant outside of this, in Europe, you get health care and you could live. You can rent an apartment, whatever. You can live. You don't have to take second, third, fourth. You don't have to get tips. You have to beg for tips. And that's the problem. And that's changing. It's going to change. And the tipping part may not change, but things are evolving in this country, and they're evolving in favor of the worker. Okay, this is chart. Some people say, "Oh, this is a terrible chart." Yeah, but it's bottomed out. Again, this goes back to World War II. We're going to see wages begin to rise versus GDP. Possibly because GDP may come down, but wages were going to rise. And real wages will rise. That's obviously good for, again, Main Street, good for consumption, Main Street, not good for Wall Street. Here's another one, reverse indicator of housing. Okay, so this is, I talked about housing, how inventories are rising, which is good, not good for realtors, not good for the Wall Street people who have been buying up all the inventory, and that's a fact. I don't care what anybody says. I talked about that 2 years ago or 18 months ago. It's taking longer and longer to sell a house. Okay, look on the upper left-hand corner, the green. That's 2025. This data goes back 3 or 4 years. Okay, it's happening. What happens when houses take longer to sell? They go down in price. So housing inventories are up, prices are going to be coming down. You don't see it yet, but it's going to happen. Don't listen to your realtor. They don't tell you the truth. Housing prices are coming down. This is good for Main Street. So what do you buy? So obviously it's tough to isolate things to buy. I'm saying, when I say Main Street, I mean the how just your life in general should get better with all of these things happening. Rising wages, lower housing prices. Unless you got money in the market, and you got to be careful with that. But what do you do? Okay, the U.S., as I said, the S&P, I think, is done. And so we're going to make your money. I have to tell you, it's going to be in emerging markets. And the main reason is, look at this valuation. I mean, the U.S. is at an all-time high in valuation. Relative to, look at these. And I mean, if I had some European companies, you'd see companies in here, you'd see them in the red as well. This is where you're going to make your money, folks. And not to get too cutesy. So if you want to get something that sort of you can think about, it's Mexico. I think Mexico is going to be an amazing investment opportunity. Why? Mexico's biggest problem is the cartels. End of story. They own the government. They own the border. But that's changed. The current administration has put military, special forces are training, in quotation marks, the Marines. You're going to see a very similar thing that you saw in the 90s in Colombia, where we had special forces training. And one day you had all these narco guys in Medellin cartel, Pablo Escobar. And then next thing you know, they're gone. Medellin was the most dangerous city in the world. Now it's one of the great cities to visit. It's a beautiful city. No crime. You're going to see the same things in Mexico, folks. You're going to see the northern part of Mexico transformed. Because what's going to happen? Cartels they're there today, they'll be gone tomorrow. It's going to be violent, but it's going to be stealth. You're not going to hear much, but these guys are going to be gone. That's bullish for Mexico. No matter what Trump says, Mexico and Canada are our best trading partners. They will continue to be our best trading partners. Mexico is going to be a huge beneficiary of this transition from Main Street to Wall Street, in my mind. So look at Mexico as a place to buy. So in conclusion, globalism is dead, meaning the growth of globalism. Globalism has happened already. There's no reason to promote it anymore. It's gone. We're seeing Wall Street taking a hit, earnings coming down. Again, the end of globalism. Companies naturally, if they bring their manufacturing back here, which can be forced to do by the current administration, they have to pay higher wages. Living wage, bad for earnings. And then you look at Doge finding all this fraud and waste. A lot of this stuff, a lot of companies benefited from selling to the government. A lot of companies. Look at all the defense contractors. Where do you start seeing what's going on there? Again, this is Wall Street versus Main Street. You're going to see a lot of issues with a lot of these large companies. So, in conclusion, Main Street should outperform Wall Street. Stocks outside the U.S. should outperform stocks, U.S. companies, large U.S. companies like the Mag 7, like these big industrial companies. Their time is over. They've had a great run. The time is over. S&P 500 index, waste of time. Means nothing. Hopefully it gets back to where it should be, but today is no longer a leading indicator, not to be invested in. So volatility is going to increase dramatically in 2025, pretty dramatically. And stay away from private credit. But no matter what, if you're an investor and you have a lot of money in Wall Street type assets, you better be very, very careful out there.